business income and loss. What we're looking at here is really what's going to be taxable, deductible, and what are some of the rules that we have connected to that. We're going to talk about three situations here. We're going to talk about partnerships and S corporation income. We're going to talk about business loss limitations, and we're going to talk about net operating losses and how these are going to be handled for tax purposes. We start with partnership and S corporation income, and we talk about these in greater detail separately, but generally certain flow-through entities such as partnerships and S corporations do not pay tax on income. Instead, the entity files what is called an informational return with the IRS, distributes a Schedule K-1 to each partner or shareholder, and the income, gains, losses, deductions, and credits are passed through to the owners based on their respective shares. And so it's the individual partners, the individual owners of the S corporation that are going to be paying the taxes and not the entity itself. But again, we'll talk about each of those in much greater detail separately. Second situation are what are called business loss limitations. A taxpayer may not take a deduction against ordinary income for a loss if the amount is not at risk or if the loss is the result of a passive activity. Okay, and so we need to make certain that we've got both of those addressed. If a loss is allowed after the at-risk and passive activity loss limitations, the deduction for the loss is then subject to the excess business loss limitation. And so we've got a few different things that we're going to be looking at here. But the four possible loss limitations that we're going to apply are the basis rules, the at-risk limitations, passive activity limitations, and the excess business loss limitations. And this is the order in which we're going to apply them to make certain that we have a loss that we're able to actually deduct. So we start with the first of these, which is the basis. Generally, a taxpayer may not claim a loss greater than the adjusted basis of their S corporation or partnership interest. You can't have a loss that's greater than the basis that you have in whatever it is that you're getting the loss from. We also have at-risk limitations. Generally, any loss from an activity subject to the at-risk rules is allowed only to the extent of the total amount at risk in the activity at the end of the tax year. Any losses that are not allowed because of the at-risk limits are deductions from that same activity in the next tax year. They're available to be used as a deduction for that activity. The taxpayer is at risk in any activity for the money and adjusted basis of property they've contributed to the activity, and amounts that he borrows for use in the activity if they're personally liable for repayment or they pledge property as security for the loan. Okay, and so these are the amounts that are at risk. We have an example here. Jim contributes $50,000 to a partnership that limits his liability. He also personally guarantees a recourse loan of $25,000 made to the partnership to purchase equipment. Well, Jim is at risk for $75,000. And that's the amount that Jim stands to lose if something goes terribly wrong with the partnership. Our third category are passive activities limitations. A taxpayer with a loss from a passive activity can offset the income with income from other passive activities. Okay? Generally, a taxpayer is unable to deduct a loss from a passive activity, but there are situations in which that is going to be allowed, kind of exceptions to that. And we can carry forward any excess passive activity loss or credit to the next tax year to use to offset against, again, passive income. The passive activity rules apply to individuals' estates, trusts, personal service corporations, and closely held corporations as well. Now, for a closely held corporation, the passive activity loss is the excess of the passive activity deductions over the sum of passive activity gross income and net active income. And there's two other kinds of passive activities: business activities in which the taxpayer does not materially participate, and rental activities. And we look at rental activities in more detail separately. But this question about material participation, the IRS will consider participation to be material if the taxpayer satisfies any of these tests. First, the taxpayer participated in the activity for more than 500 hours during the tax year. The taxpayer's participation was substantially all of the participation in the activity of all individuals for the tax year. or the taxpayer participated in the activity for more than 100 hours during the tax year and at least as much as any other individual for the year. And so with these last two requirements, we're looking at kind of that minor business. That's not full-time employment, but whereas our 100 hours is as much as anybody else spent. Or it was less than 500 hours, but that's all that was spent in the business. Now our last one that we need to look at, our last limitation, our excess business limitations. And the Tax Cut and Jobs Act limits the amount of losses from a trade or business of a non-corporate taxpayer that can be claimed in a year. Taxpayers cannot deduct overall net business losses that are more than the threshold amount. The excess business loss is treated as a net operating loss carryover. Now for the amount, again, this is going to change year to year. Don't need to get hung up on the specific amount. But for 2020, the maximum net business loss an individual taxpayer can deduct is $259,000 or $518,000 in a joint return. The amount of excess business loss not allowed is able to be carried forward as a net operating loss in future years. And we'll come back and we'll see a calculation with this. Now, included in trade or business income or loss, there's a number of things that can be included. Business income or loss, capital gain or loss, other gains or losses, rental real estate, royalties, partnerships, S corporations, farm income, unemployment compensation, and any other income, gain, or loss from a trade or business. But what we need to do is kind of bring all of this together here. We've got an example. In 2020, a single taxpayer has $400,000 dividend income and $800,000 net business losses. Okay, obviously not a very successful year. The current year business loss is limited to $259,000, and so the taxpayer reports taxable income of $141,000. That $400,000 dividend income minus the allowed $259,000 business loss. That excess business loss of $541,000 can be carried forward as a net operating loss to the next year, and the taxpayer can deduct the entire net operating loss in that subsequent year, subject to the 80% of taxable income limitation. So again, we need to see whether or not it's going to be able to be deducted in future years, but theoretically it is possible for that to happen. Now, what was happening prior to this is the taxpayer could reduce taxable income to zero with that huge loss that they have. But now there's a limit as to the amount of loss that they can take. Now, when we have a net operating loss, okay, we've got a situation where our deductions exceed income. We have a net operating loss. Some of the ways that this gets created, a trade or a business, a casualty or a theft. There may be moving expenses for the military, rental property. These are all the different ways that the net operating loss is able to be created. A provision of the Tax Cut and Jobs Act limits the current year net operating loss deduction to 80% of taxable income for loss years or losses beginning after 2017. So the way we figure our net operating loss, we calculate the net operating loss only on the income and expenses directly related to a trade or business. So these items here are not allowed. We're not including capital losses in excess of capital gains. Section 1202, exclusion of the gain from the sale of qualified small business stock, non-business deductions in excess of non-business income, and a net operating loss deduction. Those are not part of calculating our net operating losses. It's the income and expenses directly related to that trade or business. Now, we may have some non-business deductions, a loss resulting from non-business deductions that are not connected to a trade or business, cannot contribute to that net operating loss. Okay, so these non-business deductions, we cannot include alimony, deductions for contributions to an IRA or a self-employed retirement plan, health savings account deduction for a taxpayer spouse or dependents, and most itemized deductions are not going to be allowed to contribute to that net operating loss. It's the operating loss of the business. Okay, it's the income and the expenses of that entity, of that operation that we're looking at. Now, net operating losses can be carried forward indefinitely and used as a deduction in the future period, potentially. Okay, if there's income there, if we're able to offset it, and all of those things. But what we've looked at here are kind of our business income and loss. We talked about partnership S corporations, the loss limitations, okay, and the big one being there's just a maximum amount that we're able to deduct. We also have the passive income, passive loss limitations, at-risk limitations, and what it is that we're able to do with net operating losses. Again, we're trying to, as a taxpayer, maximize our benefits out of the situation, or in the best tax situation possible, and part of that is how we use the losses. And as we've seen, there are some limitations. Not all of the losses are going to be able to be used this year. Some of them are going to have to be moved into future periods, and hopefully we're going to be able to get the benefit from any losses that we couldn't use this year. We're going to be able to get the tax benefit from them in the future.